The story begins on the quiet streets of Omaha, Nebraska, in the 1930s, a city that, at first glance, seemed unremarkable. But for a boy named Warren Buffett, every corner, every newspaper stand, every coin held a story, an opportunity, and a lesson. Even as a child, Warren saw the world differently. While other boys were dreaming of baseball cards and comic books, Warren was calculating profits, tracking numbers, and thinking in terms of investment returns. His first steps into the world of money were humble, almost trivial in appearance. But they would ignite a passion that would shape the destiny of one of the greatest investors of all time. At the age of 6, Warren bought his first stock, a single share in City's Service Preferred, for $38. It was a modest beginning, but even then, he felt the thrill of ownership. He would watch the ticker, obsessively monitoring the stock's rise and fall, feeling the weight of each cent as if it were the pulse of a living organism. By the time he sold it, he had learned a lesson in patience, one that would echo throughout his life: the difference between short-term excitement and long-term gain. That early experience, small though it was, revealed to Warren the invisible threads that connected money, effort, and opportunity. Money, however, was never just about the numbers for Warren. From an early age, he approached it as a game of strategy, a puzzle to solve. He delivered newspapers, sold chewing gum, and set up pinball machines in local barbershops, not just to earn money but to understand how business worked at its core. He was not merely a boy chasing coins, he was a student of enterprise. Each venture, no matter how small, was a laboratory experiment in supply, demand, and human behavior. By the time most teenagers were struggling to scrape together pocket money, Warren was already seeing patterns that most adults would miss, recognizing the fundamental truth that wealth was not just earned, it was cultivated, studied, and respected. Even Warren's family noticed his singular focus. His father, Howard Buffett, a stockbroker and eventually a congressman, was both supportive and bemused by his son's obsession. He recognized early that Warren had a mind that operated on a different frequency. Where most kids saw candy stores or baseball games, Warren saw opportunity and risk intertwined. His mother, on the other hand, would often worry that her son's obsession with numbers and profits might rob him of a normal childhood. But even she could not deny the spark that burned brighter than anything she had seen. By the age of 11, Warren had begun to study the mechanics of the stock market in earnest. He would pore over the financial pages of newspapers, drawing graphs, noting trends, and imagining scenarios. While his peers were memorizing multiplication tables or reciting history, Warren was analyzing stock charts and contemplating dividends. It was as if the financial world had become a landscape, and he had discovered the map. Every column of figures, every report of company earnings, every story of economic success or failure was a puzzle piece in a vast tableau that he was determined to master. Perhaps most telling was Warren's first real taste of financial heartbreak. City's Services stock, after an initial climb, plummeted, and young Warren watched wide-eyed as his investment lost value. Panic, fear, disappointment, these were emotions he would encounter repeatedly over his lifetime. But more importantly, he learned the discipline of not succumbing to impulse. He held the stock through the storm, eventually selling at a modest gain. But the lesson stuck. Investing was never about emotion, it was about analysis, patience, and strategy. The thrill of profit was meaningless without the wisdom to navigate the inevitable downturns. As Warren's teenage years unfolded, his appetite for knowledge and investment grew voracious. He read every book on money he could find, including Benjamin Graham's The Intelligent Investor, which would later define his philosophy. But even before that, Warren was experimenting. He bought pinball machines and placed them in local barbershops, learning firsthand about cash flow, maintenance, and the intricacies of small business management. The money he earned was not merely income, it was tuition in the real school of finance. Each failure and success built a framework for his future, an invisible architecture of skills, instincts, and lessons that would serve him decades later. By the time Warren Buffett reached high school, his reputation as a financial prodigy had begun to spread. Classmates and teachers were astonished by his ability to turn a small investment into tangible returns, and his entrepreneurial ventures multiplied. He started a paper route, but unlike other delivery boys, Warren calculated which neighborhoods would yield the highest profits and optimized his routes accordingly. He sold stamps and coins, rented pinball machines, and made deals that most adults would consider shrewd. Each enterprise was more than money-making, it was training in the principles that would make him a legend: patience, foresight, and a relentless curiosity about how the world of business worked. What set Warren apart was not just his intelligence, it was his mindset. In a world where most teenagers were content with instant gratification, Warren thought in decades. He understood that compounding was not just a mathematical principle, it was a philosophy of life. Every dollar earned, every investment made, was a seed planted for the future. And while his peers were caught up in the fleeting pleasures of youth, Warren was constructing a blueprint for a life that would ultimately reshape the world of investing. By the end of his teenage years, Warren Buffett had amassed both experience and insight that many seasoned investors would envy. He had tasted the thrill of profit, the sting of loss, and the subtle lessons that emerge only through action and reflection. Omaha had become more than his hometown, it was his classroom, his laboratory, and his proving ground. Every corner held an opportunity, every newspaper a lesson, and every coin a chance to test the principles he was already beginning to understand. And yet, for all his early brilliance, the story of Warren Buffett was just beginning. The teenage investor, hunched over financial statements and planning his next venture, had no idea that the lessons he was learning in the quiet streets of Omaha would one day echo through Wall Street, through boardrooms, and into the lives of millions. The boy with a fascination for money was about to take the first steps on a journey that would make him the Oracle of Omaha, the man whose name would become synonymous with wisdom, patience, and legendary financial insight. Even the most brilliant minds are rarely born in isolation. Warren Buffett, despite his prodigious talent, understood early on that to rise above mediocrity, he needed guidance, examples, and lessons drawn from those who had walked the path before him. These mentors would shape not just his strategies, but his worldview, teaching him the philosophies and disciplines that would define a lifetime of investing. The first of these influential figures appeared quietly in the pages of a book. Benjamin Graham, often called the father of value investing, was a man whose writings would become a lodestar for Buffett. The Intelligent Investor wasn't merely a textbook for the teenage Warren, it was a revelation. Graham's philosophy was radical in its clarity. Investing was not speculation. It was a disciplined study of value. He taught that price and worth were not the same thing, that fear and greed were enemies of rational decision-making, and that patience could transform modest beginnings into extraordinary wealth. For Buffett, this was less theory and more a mirror reflecting the principles he had already glimpsed in his early experiments. He devoured Graham's books, rereading passages, underlining sentences, and committing lessons to memory. It was as if a mentor had appeared in print to validate his instincts and provide a framework for the chaos he observed in the markets around him. But books alone were not enough. Warren sought living examples, people whose actions mirrored the wisdom he admired on the page. He studied investors, businessmen, and entrepreneurs, observing their successes and failures with a careful, analytical eye. He understood that the road to mastery was littered with both cautionary tales and triumphs. While other teenagers idolized movie stars or athletes, Buffett idolized acumen, judgment, and prudence. He would track the decisions of prominent investors, dissecting their moves with a meticulousness that bordered on obsession, trying to discern the invisible logic that guided them. One of the most pivotal relationships in Buffett's early career was his mentorship under Benjamin Graham himself. After reading The Intelligent Investor, Buffett did something unusual for a young man. He reached out to Graham, writing a letter that displayed both confidence and humility. Impressed by the audacity and clarity of thought, Graham welcomed him into his world, and Buffett soon took a position at Graham Newman Corp., the legendary investment firm. There he was not a mere employee, he was a student in the purest sense. Under Graham's guidance, Buffett learned how to analyze balance sheets with ruthless precision, how to evaluate a company's intrinsic worth, and how to make decisions that ignored market hysteria. Every lesson, every correction, every late-night review of company reports was a brick in the foundation of what would become his investing philosophy. Buffett's time with Graham was transformative, but it was not the only influence shaping him. Omaha itself, often overlooked in the broader narrative of Wall Street, was a crucible of opportunity. Local business leaders, his father's colleagues, and even neighborhood entrepreneurs became informal mentors, each contributing fragments of wisdom. From the grocer who explained the importance of cash flow to the barbershop owner who demonstrated the power of repeat business, Buffett absorbed lessons everywhere he looked. Unlike many, he saw the world not as a series of random transactions, but as a web of cause and effect, where understanding human behavior and economic forces could yield profound insight. Perhaps the most understated yet critical mentorship came not from a person but from observation and experimentation. Young Buffett was relentless in testing his assumptions, whether it was analyzing a stock's potential, negotiating a business deal, or experimenting with a small enterprise like pinball machines or paper routes. Each venture, each transaction, was a dialogue with reality itself, a mentor that never lied, never flattered, and always demanded results. These lessons, often harsh, taught him discipline, prudence, and resilience. They showed him that knowledge without application was meaningless, and that true wisdom emerged from the combination of theory and practice. Buffett also learned an invaluable lesson in humility from observing failure, both his own and that of others. While his teenage experiments were often profitable, not every investment succeeded. Stocks fell, deals faltered, and ventures collapsed. Rather than discouraging him, these experiences cemented a crucial principle. Success was not about avoiding mistakes, but about learning from them, analyzing them, and ensuring they informed better decisions in the future. This mindset would become a cornerstone of his approach, allowing him to navigate decades of volatile markets without succumbing to fear or hubris. What set Buffett apart from other young investors was not just the mentors he found, but how he internalized their lessons. He did not simply mimic strategies or repeat maxims. He absorbed principles and adapted them, transforming them into a philosophy uniquely his own. Graham taught him value. Omaha taught him practicality. Books taught him theory. Observation taught him human behavior. Together, these threads wove a tapestry that was both methodical and intuitive, analytical and deeply human. Buffett learned that investing was as much about character as calculation, that temperament could outweigh intellect, and that the ability to think independently was worth more than any formula. Even the cultural and historical backdrop of his youth played a role in shaping the Oracle. Born during the Great Depression, Buffett witnessed scarcity, uncertainty, and economic upheaval firsthand. These experiences ingrained in him a cautious optimism, a respect for the fragility of wealth, and a desire to understand the forces that drove markets and societies alike. He observed neighbors struggling, businesses failing, and yet pockets of ingenuity and resilience emerging everywhere. It was a paradox that fascinated him. The world could be both brutally unforgiving and extraordinarily rewarding. Learning to navigate this duality became one of his earliest and most enduring lessons. By the time Buffett left Graham Newman and prepared to strike out on his own, he had amassed a mental library of principles, strategies, and real-world experiences that far exceeded his years. He understood risk, value, patience, and human nature. He had seen both failure and success and learned to approach life and markets with a careful, methodical yet bold mindset. The mentors in his life, whether living, written, or observed, had given him more than knowledge. They had provided him with vision, discipline, and the confidence to trust his instincts. And so, the teenage prodigy who had once counted pennies on the streets of Omaha was now equipped with a mental toolkit that few adults could rival. He had learned that genius was not merely in intelligence, but in preparation, observation, and character. The lessons in the shadows, the mentors, the failures, the books, the experiments had forged the Oracle before he ever set foot on Wall Street, proving that true mastery is cultivated long before the world recognizes it. The stage was set. Warren Buffett, armed with knowledge, discipline, and an insatiable curiosity, was ready to apply his insights in a world far larger than Omaha. What followed would not just define his career, it would reshape the very concept of investing for generations to come. If Warren Buffett's early years were about discovery, observation, and mentorship, then his entry into the wider world of investing marked the moment when theory became action. What set Buffett apart from virtually every other investor was not luck, timing, or charisma. It was a method, a philosophy so rigorous, yet deceptively simple, that it could weather decades of economic storms while others faltered. Patience, precision, and power, these were the pillars of the Buffett Method, and they would transform him from a talented young investor into the Oracle of Omaha. The first pillar, patience, was evident even in his teenage experiments. Buffett had learned early that wealth is rarely instantaneous, that short-term fluctuations are meaningless when measured against long-term value. He didn't chase trends, he didn't gamble on fads, and he didn't succumb to the anxiety of daily market swings. Instead, he focused on intrinsic value, the underlying strength of a business, its earnings power, and its potential for sustainable growth. This patience often baffled contemporaries. While Wall Street traders were buying and selling on a whim, Buffett would sit for years with a single investment, allowing compounding to work its quiet magic. For him, time was not an enemy, it was the most powerful ally in investing. The second pillar, precision, came from Buffett's relentless study and analytical rigor. Every investment was scrutinized with meticulous detail, every balance sheet examined line by line. He didn't rely on intuition alone. He relied on facts, figures, and a disciplined approach to decision-making. Buffett would calculate the intrinsic value of a company down to the last cent, always comparing it to the current market price. If the market undervalued the company, he would buy it. If it didn't, he would wait. Precision required patience, and patience demanded discipline. Together they formed a system that could consistently identify opportunities where others saw chaos. Buffett's analytical approach was never cold or abstracted, it was deeply human. He understood that businesses were run by people, and that human behavior often dictated market outcomes more than raw numbers. He looked for management teams he could trust, companies with ethical leadership, and operations that could sustain profits through cycles of boom and bust. Buffett's precision extended beyond spreadsheets. It encompassed character assessment, industry insight, and market psychology. This combination of quantitative analysis and qualitative judgment became the signature of his method. The third pillar, power, was the compounding force of these principles in action. By investing with patience and precision, Buffett unlocked an almost magical ability to grow wealth over time. The power of compounding is deceptively simple. Small, disciplined gains, reinvested over years and decades, create results that seem impossible in the short term. But for Buffett, it was neither magic nor luck, it was a disciplined system, honed over decades, that turned modest beginnings into monumental success. He often emphasized that wealth grows slowly, quietly, and predictably if nurtured correctly, and that short-term excitement was the enemy of true fortune. Buffett's method was also strikingly contrarian. While most investors chased hype and speculation, he sought undervalued gems ignored by the crowd. He bought when others were fearful, and he refrained when others were greedy. This approach required courage and independence. Buffett didn't follow Wall Street's mood swings. He relied on data, principle, and logic. This contrarian streak was not born of rebellion, but of reason. He understood that markets are emotional and irrational, and the most powerful opportunities often arise where the crowd refuses to look. One of the earliest examples of this approach came in the 1950s, when Buffett identified companies that were solid but overlooked by mainstream investors. He bought shares not for short-term profits, but for long-term potential, holding them for years, sometimes decades, allowing both dividends and appreciation to compound. These early successes were not flashy, but they were consistent, and they demonstrated the quiet power of a disciplined approach. Over time, they would become the blueprint for every major investment decision he ever made. Another key element of the Buffett method was his obsession with simplicity. He avoided complexity and esoteric financial instruments, favoring businesses he could understand deeply. Insurance companies, consumer goods, media firms, these were sectors where he could analyze risk, revenue, and management clearly. If a business was too complicated, he wouldn't touch it, regardless of how tempting the numbers might seem. This discipline allowed him to maintain clarity, avoid costly mistakes, and focus his energy on opportunities where his edge was real. Buffett also embraced the principle of long-term thinking in every facet of his method. He didn't just hold investments, he nurtured them, often forming deep partnerships with the management teams of the companies he acquired. His approach wasn't transactional, it was relational. He understood that a business grows best when guided by vision, supported by trust, and free from interference. This long-term approach reinforced his patience and allowed compounding to flourish, creating not just wealth but enduring institutions. The Buffett method was more than a strategy, it was a mindset. It required detachment from market noise, discipline in the face of temptation, and humility to accept what the data revealed rather than what one hoped. It required the courage to stand apart from the crowd, the precision to analyze relentlessly, and the patience to let time do its work. Applied consistently, it transformed Buffett's early teenage experiments into a career that would span decades, yielding returns few could ever imagine. Ultimately, the genius of the Buffett method lay in its combination of intellect, temperament, and moral clarity. It wasn't flashy, it wasn't instantaneous, and it wasn't always understood by the public. But over time, its results were undeniable. Through patience, precision, and power, Warren Buffett became more than an investor. He became a symbol of disciplined mastery in a world too often swept away by speculation and noise. As Buffett's career progressed, the principles he cultivated through the Buffett method would guide him through his most ambitious ventures. From building Berkshire Hathaway into a financial empire to navigating market upheavals with uncanny steadiness, by mastering patience, precision, and power, he had developed not just a strategy for investing, but a philosophy for life itself, a philosophy that would ultimately define him as the Oracle of Omaha. If the Buffett method was the blueprint, Berkshire Hathaway was the canvas on which Warren Buffett would paint his masterpiece. What began as a struggling textile mill in New England would become the engine of an empire, an improbable story of patience, ingenuity, and the quiet accumulation of power. But the rise of Berkshire was far from predestined. It was marked by risk, controversy, and a relentless application of the principles Buffett had honed over decades. The journey began in the early 1960s, when Buffett first encountered Berkshire Hathaway, a textile company struggling to survive in an era of shifting industries and rising competition. To most investors, the company was unremarkable, a dying firm with fading prospects. But to Buffett, it was an opportunity to apply his philosophy, a tangible asset with value, mispriced by the market, and a chance to test his discipline on a larger scale. Initially, he invested with caution, acquiring shares gradually, all while studying the company's operations and financials in minute detail. Every decision was calculated, every dollar scrutinized. But as Buffett's involvement deepened, it became clear that Berkshire Hathaway was more than just a textile mill, it was a gateway. While textiles were declining, the company had assets and cash flows that could fund acquisitions in other industries. Buffett saw the potential to transform the struggling firm into something far greater, a holding company that could absorb profitable businesses, allow them to operate independently, and generate compounded wealth over decades. This vision required patience, a contrarian mindset, and a willingness to embrace calculated risk, all hallmarks of the Buffett method. Acquisitions became the heart of Buffett's strategy with Berkshire. One of his first major moves was buying insurance companies, which provided both cash flow and a pool of funds to reinvest in new opportunities. Companies like National Indemnity became foundational pillars for the empire, offering predictable earnings while freeing Buffett to expand into other ventures. Through insurance, he discovered a mechanism unique in the financial world, the float. Premiums collected in advance provided massive leverage for investments without using his own capital. It was a stroke of genius that amplified his power, demonstrating the synergy between methodical strategy and opportunistic thinking. But building an empire was not without drama. Buffett faced skepticism, criticism, and outright hostility from competitors, Wall Street analysts, and even shareholders who didn't understand his vision. Critics questioned why he was buying a declining textile company or investing in businesses far removed from conventional wisdom. Yet Buffett remained unshaken. He trusted the principles he had cultivated for decades: by value, cultivate patience, invest with precision, and let compounding work its quiet magic. Over time, the critics faded as results spoke louder than speculation. Berkshire Hathaway's transformation accelerated in the 1970s and 1980s. Buffett began acquiring businesses that fit his criteria: strong brands, capable management, and consistent profits. From insurance and utilities to consumer goods and railroads, the empire grew in size and scope. Yet Buffett remained true to his core philosophy. Each acquisition was carefully vetted, each management team allowed autonomy, and each investment measured for long-term value rather than immediate profit. The empire expanded not through reckless ambition but through disciplined strategy, illustrating how patience and precision could yield extraordinary power. One of the most dramatic moments in Berkshire's rise came with the full-scale shift away from textiles. The business was failing, yet Buffett had already built a foundation of profitable subsidiaries and investments that could sustain the company. Instead of clinging to a dying industry, he pivoted decisively, allowing the empire to evolve. This decision encapsulated Buffett's approach: recognize value, act boldly when logic demands it, and remain steadfast in principle while flexible in execution. By embracing change strategically, he demonstrated that even an empire rooted in tradition could adapt and thrive. Buffett's rise was also defined by a remarkable focus on reputation and trust. He famously avoided debt when unnecessary, maintained transparency with shareholders, and cultivated a culture of ethical stewardship. In a world where greed and speculation often ruled, Buffett's credibility became a cornerstone of his power. Partners, managers, and investors knew that the Oracle of Omaha operated with integrity, patience, and foresight. This reputation allowed him to negotiate deals, attract talent, and make bold acquisitions with confidence that few others could match. By the end of the 1980s, Berkshire Hathaway had evolved from a small textile company into a diversified conglomerate, controlling billions of dollars in assets and earning a reputation as one of the most successful investment vehicles in history. Yet even as wealth accumulated, Buffett's focus remained on the principles that had guided him from Omaha streets: value, patience, precision, and the compounding power of time. Berkshire's rise was not a product of chance. It was a testament to a lifetime of disciplined practice, informed judgment, and relentless application of timeless principles. The story of Berkshire Hathaway is also a story of vision. Buffett saw opportunity where others saw decline, potential where others saw risk, and value where others saw uncertainty. He understood that empires are built not in moments of excitement, but through quiet, deliberate accumulation over years. Each acquisition, each decision, and each calculated risk was a brushstroke in a portrait of financial mastery, illustrating how discipline, insight, and courage could transform a modest company into a global powerhouse. And yet, even as Berkshire Hathaway rose to prominence, Buffett remained grounded. He lived modestly, maintained his focus on investing rather than personal indulgence, and used his influence responsibly. His story was no longer just about profit. It was about building an enduring legacy, demonstrating that true power comes not from wealth alone, but from wisdom, integrity, and the consistent application of principle over time. The rise of Berkshire Hathaway stands as one of the most compelling chapters in the history of modern finance. It is a story of vision meeting opportunity, of patience yielding power, and of disciplined strategy overcoming doubt and uncertainty. Through this empire, Warren Buffett became not just a successful investor but a living legend, a testament to the transformative power of method, principle, and relentless perseverance. Warren Buffett's story is often told in numbers: billions amassed, decades of market dominance, legendary returns. But to reduce the Oracle of Omaha to mere wealth is to miss the deeper narrative, the legacy he crafted through wisdom, influence, and the careful shaping of a philosophy that extends far beyond the stock market. Buffett's legacy is not just the empire he built, it is the blueprint he left for investors, leaders, and generations of dreamers who seek to understand what it means to create enduring value. One of the most remarkable aspects of Buffett's legacy is his steadfast commitment to simplicity and discipline. In a world awash with financial instruments, complex derivatives, and speculative mania, Buffett's approach remained grounded in the basics: buy quality businesses at fair prices, understand what you own, and hold for the long term. His insistence on clarity over complexity has not only defined his career but also provided a roadmap for millions who struggle to navigate the chaos of modern finance. The Oracle's genius lies not in flashy moves, but in the quiet mastery of principles that have stood the test of time. Equally defining is Buffett's approach to character and ethics. He has repeatedly emphasized that integrity is far more important than intelligence when it comes to long-term success. This philosophy permeates every decision he makes, from the management teams he trusts, to the companies he invests in, to the way he communicates with shareholders. His annual letters, now legendary in the world of finance, are lessons in honesty, humility, and rational thinking, offering guidance far beyond the numbers on a balance sheet. Buffett's insistence that wealth must be earned responsibly and that one's reputation is invaluable is a lesson as timeless as the principles of value investing he champions. But perhaps the most enduring aspect of Buffett's legacy is philanthropy. Despite amassing unimaginable wealth, Buffett has committed the vast majority of his fortune to giving back. His pledge to donate over 99% of his wealth, primarily through the Bill and Melinda Gates Foundation, represents a philosophy that wealth is a tool, not an end. It is an acknowledgement that the true measure of a life well lived is not what you accumulate, but what you contribute. In doing so, Buffett has transformed his fortune from a personal triumph into a force for societal good, inspiring countless others to consider how they might use their own success to create impact. Buffett's influence extends beyond philanthropy and investing into the realm of education and mentorship. Through his writings, interviews, and example, he has taught generations the value of patience, critical thinking, and disciplined action. Unlike many financial figures who operate behind closed doors, Buffett shares his insights openly, demystifying investing and making it accessible to ordinary people. His philosophy is not exclusive, it is replicable, grounded in principles that anyone can understand if they are willing to learn and apply themselves. By doing so, Buffett has created a living legacy, one that continues to shape investors, entrepreneurs, and thinkers worldwide. A subtle yet profound aspect of Buffett's story is his humility and humanity. Despite his wealth and fame, he lives modestly, continues to reside in the Omaha home he purchased decades ago, and maintains a life defined by simplicity. He drives his own cars, favors simple meals, and avoids the ostentation often associated with extreme wealth. This humility is more than a personal quirk. It is a reflection of his core belief that true value lies not in material accumulation, but in wisdom, discipline, and the careful stewardship of resources. In a world obsessed with excess, Buffett's life is a quiet lesson in restraint and perspective. Buffett's legacy is also woven into the culture of Berkshire Hathaway itself. The companies he has acquired operate with autonomy, guided by trust and mutual respect rather than micromanagement. This decentralized approach has allowed creativity, innovation, and profitability to flourish, proving that leadership is not about control, but about setting principles and empowering others to succeed. The corporate culture he has nurtured reflects the very ethos that guided him from his earliest days: rational decision-making, patience, ethical conduct, and long-term thinking. The Oracle's life story serves as a lens into the broader lessons of finance and human behavior. Buffett has repeatedly shown that markets are influenced as much by psychology as by numbers, and that rationality, discipline, and ethical judgment are far more powerful than speculation or luck. In this sense, his legacy transcends individual wealth. It teaches us how to navigate complexity, understand risk, and make decisions that endure. It is a philosophy that can be applied to business, investing, leadership, and even personal growth. Perhaps the most cinematic element of Buffett's legacy is the narrative arc itself. A boy obsessed with coins and paper routes in Omaha grows into a man whose insight and patience influence global markets, philanthropy, and generations of learners. It is a story of curiosity, discipline, mentorship, and relentless application of principle. Every investment, every decision, every lesson he shared contributes to a mosaic that inspires, instructs, and challenges us to rethink what success truly means. Buffett demonstrates that mastery is not accidental, and that greatness emerges from consistent application of wisdom, often unseen and unheralded over decades. In the end, Warren Buffett's legacy is a testament to enduring principles. Wealth, yes, but also patience, integrity, curiosity, and generosity. His life teaches that true power comes not from taking shortcuts or succumbing to trends, but from disciplined learning, principled action, and the courage to follow a path few others are willing to walk. From the first dollar earned in Omaha to the billions managed through Berkshire Hathaway, Buffett's journey illustrates that mastery is cultivated, influence is earned, and a life of purpose is infinitely more valuable than a life of mere accumulation. As the Oracle continues to shape markets, philanthropy, and minds across the globe, one truth remains clear. Warren Buffett's story is not just about money, it is about the disciplined pursuit of excellence, the wisdom to act with integrity, and the power of patience over time. It is a story that will endure long after any single investment or empire, serving as both inspiration and guide for those who dare to dream, study, and act with principle. The boy from Omaha became the Oracle, not because of luck, but because he mastered himself first, and then the world of finance.